Welcome everyone. Welcome to SumZero. My name is Griffin Marie, and I'm a relationship manager for the SumZero team. Thank you all so much for joining us today on what should be a terrific fireside chat with two names I think that anyone on SumZero should be well familiar with. So with that, I'd like to first welcome Jeff Meyers from Cobia Capital Management. Jeff is the CIO of Cobia, having founded the firm in 2008. Cobia is a value-oriented long-short equity fund focused on opportunities in small-cap technology names. Chances are, if you've been on SumZero, you're well acquainted with Jeff, not only his prolific research contributions over many, many years, but also his activity in the community more broadly. Joining Jeff for today's conversation is the CEO of Franklin Covey. The ticker is FC. Paul Walker is joining us today. Paul has been at Franklin Covey for over 2 decades in multiple positions, having started his career there as a sales development associate. In 2014, Paul took over the company's UK business before moving to the company's Utah headquarters in 2016. Now, Paul has led several transformational projects for the Franklin Covey's business, including spearheading the firm's M&A strategy. Now, Jeff has written an extensive research report on FC that can be found on SumZero. And despite the broader market weakness, the stock has held up admirably over the past year or so. If you'd like to access that report, get in touch with me. I'd be glad to pass it along to you. So with that, you guys are probably sick of hearing me talk. So I'm going to pass things over to Jeff Meyers here. So Jeff, all yours, take it away.
Thanks so much. Thanks, Griff. Thanks, Paul, for joining us today. I guess Griff gave a little bit of your background.
I joined the company 22 years ago this month, actually. And my first role, I've always been on the sales side of the organization. My first role was in an inside sales position. I didn't grow up here in Salt Lake, but I went to school here and started with the company here. Did that for a year and then moved to Chicago and was in Chicago for 14 years, where our term for sales professional is client partner. I was a client partner. We'll talk probably more about them and that role and how critical that is here a little bit later today. But I was in that role for a number of years and then moved into various sales management roles, led the North America Central region for the company, which was our largest region at the time. And then, as was mentioned, did that and was asked to also look after the UK. So I would travel over monthly from Chicago to the UK for 2 years and kind of got that business onto a little bit better footing. And then was invited by our then Chairman and CEO Bob Whitman to move back to Salt Lake 7 years ago. So my family and I've got 4 kids. My wife Melissa and I and our 4 kids moved here to Salt Lake 7 years ago, where I initially led all of sales and delivery globally, and then became the president of our enterprise division, and then the president chief operating officer for the company. And then a year ago this month, moved into the CEO role, when our longtime chairman and CEO, Bob, as I mentioned, Bob Whitman, moved into a chairman role. So I'm just finished my first year as CEO, and that's a little bit about me.
Terrific. Well, Paul, already doing a good job at the CEO role. So maybe you can take it a little broader, I guess, into what Franklin Covey does, and then also maybe talk about how the products have moved from more of an a la carte to as a service type business.
Okay, absolutely. So I see a couple of names on here that are familiar, but so apologies to those who know the story well or who have already gone into Jeff's report in detail. But I'll give you a little bit of a high level here. So Franklin Covey is the result of a merger 25 years ago between 2 organizations. The Franklin side, Franklin Quest was the company. 40 years ago they started, and they became a public entity. You may remember the Franklin planners, kind of the daytimer style planners, retail stores in the malls. Most decent sized malls in the US had a Franklin retail store. That was that side of the business. And in its heyday, there were about 7 million people using the Franklin planner. But at its core, it was a business trying to help figure out how could you help people change behavior and sustain that behavior change. The business was built around kind of prioritizing your life, managing your time, et cetera. And the tool was this paper-based planner. The Covey side of the company also, interestingly, started about 40 years ago. There was a gentleman named Stephen R. Covey who wrote a book called The 7 Habits of Highly Effective People. One of the best-selling books of all time, and certainly the best-selling of its of its type, which is all around how do you become a more effective individual. And he kind of consolidated, hundreds of years worth of research into this book. If you haven't read it, great book, you ought to read it. The companies were independently doing their own thing. That company was kind of a leadership consultancy, working with organizations to improve their performance. They merged 25 years ago, and because the Franklin side was public, the company remained public, and into what is today known as Franklin Covey. And at the core, the company, in the DNA of the company, is this organizational performance improvement company focused in 4 areas. We help organizations, by the way, of all sizes, and we'll get into the market here in a little bit, in a few minutes, the market that we serve, but helping organizations of all sizes around the world in 4 areas. And these are the 4 areas that, as we've been doing this for more than 2 decades, or nearly 4 decades. We continue to see organizations needing to make progress and struggling to make progress in 4 critical areas. One is, can they field the best teams of leaders possible? So we work closely with organizations all over the world on developing their leaders, their leadership bench strength, their leadership capability. That's the first area. The second area is on creating habits of effectiveness inside individuals. We're not on the tech or hard skills or technical skills side of things, but we do a lot of work on more of the softer interpersonal skills. Can people manage themselves? Can they communicate effectively? Do they have high emotional intelligence? All those things that when you're on a team of people who really are interpersonally effective, it works really well. And when you have that one person or those handful of people on the team that aren't that, everything slows down, everything gets bogged down. So that second area we focus is on kind of the interpersonal, individual effectiveness sets of skills and behaviors people need. The third area we help our clients with is around culture, creating high trust, inclusive cultures. And the fourth is around strategy execution. We have we wrote a book about 18 years ago, called The 4 Disciplines of Execution. And it's today the largest best-selling book of its kind around how do you execute strategy, where the execution of the strategy is going to require people to do something different, as opposed to the types of strategies where, because you have a big enough pen and a big enough checkbook, you can just sign a check and make the strategy happen, but where you actually need people to do something different. We have a process and a methodology for that. And so it's in those 4 areas that we have historically worked with clients. And what we do is we develop our own intellectual property in those areas, and the supporting training and tools and resources that clients need to deploy these solutions at scale across their entire company. Or we will partner with somebody else who has the best IP out there and is looking for distribution, where that IP is consistent with our view of the world and kind of our core principles and frameworks. And so we're a bit agnostic about where we get the ideas, but we want the best ideas. And historically, we went to market kind of episodically, one client at a time, one solution at a time. That was good. It served us well. It created an organization that grew kind of mid to high single digits revenue, always being, a profitable organization. We always prided ourselves in flowing through a good portion, 30-40% of incremental revenue to adjusted EBITDA, but the business didn't grow that quickly. It was kind of a, high single digits grower. 7 years ago, actually right now, 7 years ago, the time I moved back from Chicago, our then CEO, Bob, came in the office one day and said, we're not serving the clients the best way we could. Our model gets in the way of this. Our model is kind of work with organizations to try to cull down the numerous things they need to make progress on, down to the one thing that everybody in the organization can agree on. And then we'll sell one solution against that one problem. We'll implement it, and then we're back in trying to sell the next solution some number of months later. All the while, we uncovered, and we know these organizations are dealing with myriad problems, and we have solutions to a lot of those problems. Why don't we engage with our clients in a way where they can gain access to all of our content and effectively be an owner of the content and the tools, and let's help them with lots of things simultaneously. Believe it or not, that idea wasn't because we were trying to become a subscription company. In fact, it's kind of a joke now, but we fought against that. our auditor said, well, that's a subscription business. And we said, no, it's not, because we didn't want to go through the accounting transition as a public company and take all of our shareholders on a journey of having to switch the accounting to subscription. But of course, that is the definition of a subscription business. And today we are one. But 7 years ago, that was the idea could we rework and come up with a better business model that would be better for our clients? And we bet that if that was the case, it would be better for us. And it's turned out to be that way. So today we're a company with 2 subscription engines in it. Our All Access Pass subscription engine, which is all of the content, intellectual property, tools, resources that we have for our enterprise clients. So that subscription is called the All Access Pass. We serve it up via the cloud, and we sell subscriptions on a per head basis for a portion or an entire enterprise worth of people. And then we add services to that, value added services to that, where we come in and do training or coaching on top of the subscription that we sold. And then we have another division of the company, which is our education division, which is very similar. It sells a subscription to K-12, primarily K-12 schools. That subscription business is called The Leader in Me, where we're selling school transformation and student leadership development solutions to schools, and then we sell services on top of that as well. That transition turned out to be great for the organization. It took an organization that had historically kind of grown high single digits, and it's now growing low teens. And as we top line low teens, and as we continue to convert the entire company to subscription, which we think will happen over the next couple of years, we expect that the top line revenue of the company will move into the mid-teens. And then from there, because of the flywheel, the subscription flywheel that's spinning and working quite well, that we actually ought to be able to move into up to the high teens and maybe even approaching 20% in the out years over the next, not the next couple of years, but maybe 3, 4, 5 years from now. And while we're doing that, we continue to flow through substantial amounts, 30-ish, 35% of incremental revenue to adjusted EBITDA. And so as we're getting, low teens revenue growth, we're also seeing significant EBITDA expansion at the same time. Last couple of points just about the company overall. That subscription business we started 7 years ago, in its first year did about 30 million in subscription and related revenue. And we report at the end of our third quarter, we're on a September to August fiscal year. At the end of our third quarter in May, that subscription business on a rolling 12-month basis had grown to about 190 million. So compounded growth rate on that was a little over 30% over the roughly 6.5 year period. And we continue to see that business grow very, very nicely. And that's what's pushing the overall growth rate of the company. Today, about 65-ish or so % of the business is now made up of that subscription and related services revenue. And we think that eventually about 90% of the revenues will be subscription and related. And that's what's so what you have is this fast growing SaaS-like subscription business inside this company that's growing faster and faster and pushing the growth rate of the overall company higher. So Jeff, that's probably more than you wanted. If it was, sorry, too late now. But that's a little bit about what we do, where we've been, and the transition we made 7 years ago that frankly probably is why you and others are interested in hearing from us.
Terrific. Well, thank you. So how about maybe just talk a little bit about, the market that you guys play in, your positioning in the market, and how you see that changing over time.
Yeah, let me throw up a slide here. It might help for those who are in a position to see slides. The market, so I mentioned earlier, can you see that slide, Jeff?
Yep.
Okay. So I mentioned earlier, we go to market in 2 divisions. Our enterprise division, which comprises about 75% of the company's revenue and profit, and our education division, which is about 25% of the company's revenue and profit. The enterprise division serves primarily corporations or government entities of all sizes. An ideal customer for us, today, because we don't have a small business division yet, it's kind of 250 employees or larger. and we serve all the way up to the Fortune 50. That market for us, the global spend on training and development is about 381 billion, of which about 99 billion of that is spent with outsourced providers like us. And so about 70% of our sales within the enterprise division are made to titles like Chief Human Resource Officer, Chief Learning Officer, Vice President Talent Development. It's the people who are responsible for making sure that employees at all levels have the skills and capabilities they need that are tied directly to the outcomes the organization is trying to achieve. About 30% of our sales and enterprise division are made to actual business leaders themselves, CXO level people who are trying to do things like improve sales or improve their ability to execute on their key strategic outcomes. That market is, it's trillions. It's the market that people like me spend on solutions and services to get things done that are important to the overall organization. So very, very large market we serve there, those two markets. And in our education division, there's the market is about 760 billion is spent in the US K-12 market, and about 59 billion of that is spent on the kinds of things we do. I mean, instruction, this is a broad category, instructional resources and services, but also a very, very large market. And so today we're serving thousands of organizations and thousands of schools in our two divisions.
Terrific. Paul, you I think it was last year, you guys made a pretty important acquisition, a company called Strive. Maybe you could describe, why you made the acquisition, what that's brought to the organization, and where you are rolling that out and the impact you think that's going to have on your business.
Yeah, great. So I'll put, again, for those who can see slides, let me put a slide up and to illustrate something as I talk about Strive. So I mentioned a minute ago in the opening that we're as one of the largest leadership and organizational transformation companies in the world, we're focused in these four areas: leadership, individual effectiveness, culture, and execution. We chose these areas because we recognize that in order for organizations to achieve the results they need to achieve, you need to excel in these four areas. And these are areas where by definition, you're not going to accomplish what you're trying to accomplish if you only have a small portion of your leaders or a small number of your associates across the organization who have the skills and behaviors they need. These are the types of problem areas where you need collective behavior change, common language, common use of a standardized tool set. These are the best performing organizations. They achieve collective behavior change, collective momentum, and that's really what we do. And that's illustrated here on this next slide. What we find inside, and I promise I'll get to the Strive, where Strive fits in, Jeff, but I think this is maybe helpful context.
Sure.
What we find as we work inside thousands of organizations annually is that everybody has a performance curve in their organization where, if you just take a look at all the leaders across the company, you'll say, gosh, we have leaders that fall across this distribution curve where some of them are exceptional. And if everybody led the way Jeff leads, this place would be achieving way more than it is today. And on the other end of the spectrum, you have people who, frankly, probably are on their way out. And what you have is most people tend to bunch up in the middle. They're kind of average performers. The opportunity, therefore, that every organization has is to move that performance curve righter and tighter. What we find is that a lot of organizations, they know that they have pockets of excellence, but they don't necessarily know why that pocket of excellence is a pocket of excellence. And even if they do know that, they don't really know how to systematically move everybody towards the behaviors that would move that performance curve righter and tighter. That's essentially that's our value proposition to our clients, is that we know how to do that. Every solution we've assembled is designed to move lots of people, individuals, but also collectively lots of people righter and tighter on this curve. And we do that through a unique combination of best-in-class content, frameworks, methodology, principle-based content that causes people to think differently and then supports that new thinking with a set of behaviors and a set of tools that will allow them to sustain that behavior change over time. We combine that with our own internal experts, people who go in and deliver content and coach around that content. And increasingly, technology plays a really big role. I mean, at our core, what we are is a behavior change company. We're helping organizations change the collective behavior of lots of people in those 4 category areas. We've been able to do this for a long time, but frankly, we were not born as a technology company. We were born as a content company and a people delivery company. Those have been the areas where we've always rated really, really highly. Our NPS is off the charts high as it relates to our content, the quality of the content, and the people that go in and deliver that content. But we were not a tech company. We acquired Strive to bring together that third critical element, which is the technology platform, to make it easy for clients to deploy our solutions at scale and to make it a really elegant experience for the end user consumer. I'll give you a quick metaphorical example here. Not because their stock performance has been great, but because I think that what they're trying to do is analogous to what we're doing. Peloton. So pre-Peloton, if you were interested in getting in shape and exercising, you could go and you could manufacture and simulate the experience that Peloton now has integrated. You could go down, if I wanted to do that, I could go buy a bike, I could put it in my basement. If I wanted to have a live instructor, I could hook a TV up, put it on the wall, tie it into the internet, and find my favorite YouTube instructor. If I wanted to have a cohort riding experience where my buddies could hold me accountable, I could get an iPad, put it on a stand next to me over here on the left, and I could get on FaceTime with a bunch of my buddies and we could ride at the same time. If I wanted to keep track of my stats over time, because that's engaging, it's helpful to see how I'm making progress, I could get a whiteboard, put it on the other wall, get a marker out and keep track of my stats, right? I could, it turns out, by the way, those are all the elements that you need to create an engaging experience that would cause you to want to get on the bike every day and ride, and would help you create new habits and sustain those habits over time. We've always known that that's what you need to put together, but before Peloton, it was, the enlightened, very focused few who would go to the work to assemble all of that and try to make it work every day. Peloton said, we understand the behavior change science, and they integrated all that into one really powerful, seamless user experience. I saw a stat the other day that people who started on Peloton, like 85% of them are still actively using it every week. Like, it's a really successful story. Again, not talking about how they've have or haven't financially run the company and some of the decisions they made, but what they're after is similar to what we've tried to do. Prior to us acquiring Strive, we had all those pieces as well. And we and our clients knew that in order to create a true behavior changing experience, you needed to take people on a journey, not just bring them into a classroom for a day, but that journey needed to consist of assessments up front, a really powerful cohort experience with a live instructor. That could be live online or live in person. You needed to have metrics supporting people along the way. You needed to be able to give feedback on how their behavior is changing. You needed to have stuff that, not in between the live cohort sessions, you needed coaching and you needed asynchronous development opportunities. We had all those disparate pieces, but it was more difficult than it should have been for our clients to assemble it all and to deploy it to large numbers of people in their organization. Knowing that, we went on a bit of a search to find a technology platform that could do that. That was Strive. Strive was a Silicon Valley-based startup. They had 70 or 80 clients at the time, but they were tech guys at their core, not content people, but they were trying to do the same thing we were trying to do. They were trying to impact the way leaders performed and behaved. And we saw this marriage of our best-in-class content and people with their really, really best-in-class technology platform. We bought it a year and a half ago. We did some early piloting of it. It went really well. Our clients were really high on the idea, and it was scratching the itch we and they had, which was, how do we deploy Franklin Covey's great content with more ease, but not lessen its ability to drive behavior change and impact. We've now put all of our content on it. We've reformatted it so it runs on Strive. And we launched to about 260 clients this summer in a limited launch phase. Went really well, got a lot of important feedback, and we're launching to all of our English-speaking clients on October 18th. And then we'll roll out. We support about 22 languages. We'll roll out to the remainder of the languages starting in January, and that'll be kind of a phased rollout through the rest of our fiscal year. Just last point, Strive is not, we are not a online learning library catalog company. We're not LinkedIn Learning, we're not Coursera, we're not Udemy. That is a modality we support, but we are actually kind of, we don't think that is the satisfactory solution that companies need. Those solutions were built where these companies have amassed 30, 40, 50,000 different course titles. And the value proposition is, hey, we bought this for you, Mr. or Ms. Employee. Go in, knock yourself out, figure out what you're interested in, and train yourself on things that you think will help advance your career. There's a value to that, but we think that's an insufficient way to go about making sure everybody in the company develops the skills and capabilities that they need in a uniform way to drive the overall company in a consistent direction. So we come at it a little bit the other way. We're partnered with the organization, not with the end user, making sure that the organization is getting the skill and capability development that they need. And so Strive is bringing together these three important pieces of great content, but with that ability to have the live or live online cohort-based experience with the facilitator that will challenge and push on you, and the individual or team coaching with the technology platform. And so that's Strive. We're thrilled about it. We really are happy. And in addition to acquiring their great technology, we got a heck of a team. And so we now have legit tech, bones inside the company that's going to help take us in directions that we wouldn't have been able to go on our own otherwise.
Terrific. Okay, thanks. How about, so this is something obviously top of mind probably to you and everyone else on the call, which is, current economy, recession, not recession, going into recession. How do you think your business is going to fare? Like, what are the main things we should be thinking about going forward?
You're the first person that's asked that.
Yeah.
No, just kidding. So obviously don't know exactly what the world's going to look like, but increasingly day by day, it looks like it's going to be a unique and difficult environment in the next period of time here. In my 22 years with the company, this is not the first one of those that we've gone through. And each time we've gone through one, whether it was the post.com bubble burst and post kind of 9/11 period, or it was the great financial crisis, or it was the early days of COVID, our business has fared better and better each time we've gone through one of those. And the primary difference between those early days back right at, in the early 2000s to where we are today, the first big change, the change that was constant through all that, was we continued to refocus the company year by year onto the types of problems that are very durable. The things we're helping our clients with today are needed in good times and in challenging times. And you might argue that they're needed even more so in challenging times. There's a premium on strategy execution. Right now, today, there's a big premium on culture. It's an interesting environment with as much as there is going on the recession and inflation front. There's still a massive war for talent out there, and employees expect a certain type of culture, and CEOs are recognizing that culture is really a competitive advantage. When I first started in this business 22 years ago, I was selling, and it was the enlightened occasional CEO who recognized the value of culture. They cared more about other things. Today, you're not going to be a CEO very long if you haven't really embraced, I got to have the best talent, I got to have the best culture. That really does make a difference. And so we're on these topics that are very durable. That's the first thing that gives us, a measure of confidence going into a downturn. But there are, I think, 4 other things that are important to understand. Not only are we on the right topics, we've assembled the best solutions to those topics, and they're seen that way by our clients. They really are seen as differential. And when times get more difficult, you got to get out of the the thick of thin things or the nice to haves. You're only going to continue to invest in the things that you know really do make a difference. And we've tried to always live on that side of the line. We're not satisfied if we're not delivering measurable behavior change and results and outcomes. Our usage is very high because, again, we're attaching ourselves to the organization's initiatives. These other providers that are library providers, their usage is really low and their completion rates are almost non-existent because they're attached to the individual and their time and their bandwidth, right? And so we're on I think, the right side of the equation, certainly, always, and particularly in downtimes. The third point is we now have a business model that we didn't have in some of those prior downturns. So we're as a subscription business, increasingly, all of our contracts are at least 1 year. So maybe something to point out I didn't mention earlier is that we sell an minimum annual contract. Our clients pay us up front. So we collect all the cash up front. 42% of our contracts now are multi-year, meaning that they're 2 years or longer. And that comprises 58% of the revenue. So more than half of our subscription revenue is multi-year in nature, 2 years, 3 years, 4 years, some are 5-year long contracts. So we have much more visibility, predictability, and durability in the revenue streams because of this subscription business and the multi-year nature of it. The fourth point I would say is we have a lot of headroom for growth. We're a land and expand model much more than we are an enterprise wide. We don't have very many, like less than 10, where we've actually sold an enterprise wide contract. And why I think that's important going into a downturn is that what we've seen we saw this in the early days of COVID for sure, that organizations will think a little bit more carefully about how they invest their dollars and where they invest them. And to the extent that you're a single solution provider and Franklin Covey comes along and we're a multi-solution, multi-modality provider in 22 languages who can meet your needs globally around the world with local people in over 140 countries, our value prop looks pretty compelling. And so we saw in the early days of COVID, and we're seeing it today, where companies will rationalize their spend with vendors. And some of our clients today have 15 or 20 different partners they work with to get the job done. They don't need that many. They can let some of those relationships go, double down with us, and we can actually expand our share of wallet while that company is reducing their overall spend in the downturn, and they're doing it by eliminating some of their partners. So we have this great expansion opportunity inside a lot of our clients. I would say, we're roughly 1/5, 1/6 penetrated inside the average client of what we think is our addressable population. So a lot of headroom for growth there. And then finally, we do generate a lot of cash. Where our EBITDA margins, we've reported this in the third quarter, are about 16%. We see expansion of that margin. We've kind of put that out there that we think it ought to go 16 to 17 to 18 to 19 to 20, maybe, increasing 100 basis points or so a year until we haven't really modeled it out past the 20%. Theoretically, it probably ought to keep going up as the business transitions to this, high gross margin subscription business. But we do generate a lot of cash. Cash is a great thing to have, and certainly in times of difficulty. So, will it get harder? Absolutely, right? But are we well positioned? I think we are. I think we're significantly better positioned as we go into this one than we ever have been in the prior 3 that I've been involved in my 22 years.
Got it. Okay, terrific. Maybe talk a little about, you mentioned, the war for talent that's going on out there. Maybe you can talk about your own growth of your sales force, how that's been going, what you've been investing, to make that happen.
Yeah. So maybe let me, I'll put up another slides for those that are interested in that. It might be helpful just to talk about first, the global nature of this business. So Franklin Covey operates direct. It's our employees, our brick and mortar, our direct offices in the countries you see here in the, royal blue. The US and Canada being our largest operation, but we're in the UK, Ireland, Germany, Switzerland, Austria, China, Japan, Australia, and New Zealand. So there it's all Franklin Covey offices. And then you see in the turquoise, we have about 60 licensee partners that cover another just over 140 countries. And so if you think about the overall makeup of the revenue, we were, 260 million or so ish in top line revenue. You've got about 190 million of that is this subscription and related subscription services revenue that's growing very, very rapidly. But we have around about 15 million or so that's this very durable, high recurring licensed revenue. So our partners around the world pay us 15% off their top line sales as a licensing royalty. And that's how, and we have tremendous scale and coverage, one of the largest, if not the largest coverage footprints in our industry. And it's important because not only do we do business with local companies in those local countries, but multinational companies around the world can count on us, again, because we're trying to be the behavior change and collective behavior change. Companies need this across their entire organization, and we can service them with local people on the ground, whether it's our own direct employees or our partners. We recognized many years ago that a key to growth would be growing our sales force. And you can, whoops, that's the compounded growth rate of our subscription services business. That's a great chart too, but that's not the chart I was going to point to. We recognized years ago that growing our sales force would be a key to growing the overall company. And back in 2012, we had about 120 direct salespeople. We call them client partners. And we started to build out the infrastructure to grow that more rapidly. We set a goal to say, okay, how do we add net 10 new a year? And then how do we bump that to net 15 a year? And then to net 20 a year? Today, we expect that when we report on where we ended fiscal 22, that we will have more than 300 client partners now, up from 120. And we've given a projection in our last earnings call that we would, so that would be net, we grew, that would be net 30 added this last fiscal year, and that we would then go to net 40 this next year. So we've been building the infrastructure to add these client partners. It's a great growth engine for us. The average client partner that we hire, we expect that they'll do 200,000 their first year, 500,000 their second year, 800,000 of revenue their third year, $1.1 million their fourth year, and $1.3 million their fifth year. That's the ramp schedule, the ramp expectation for new client partners when we hire them. And we pay that, all in, we're paying roughly $140,000 or so. So even in the first year at 200,000 of revenue, we're close to break even. Our gross margins, by the way, are in the high 70%. And so we have very high gross margin. And so after $200,000, that high gross margin, even after paying them and paying some of their training costs, we're close to break even in that first year. And then we're making, a great return on that new client partner in years 2, 3, 4, and 5. After they're at 1.3 million, we expect that they'll grow between 8 and 10% or so a year in aggregate. Because of the significant hiring we've done over the last 4 or 5 years, we have a lot of latent built up revenue growth just in the 300 that we have today. They're doing well, but they're not fully ramped yet. So the average revenue per client partner today is around $850,000. And that's a reflection of the people many of them that are ramped, but so many who have been hired the last 2 or 3 years that are kind of midway through that ramp from 200,000 in their first year to 1.3 million at the end of their fifth year. So between those that are ramping and the growth that's latent and ready to be captured and realized there, and the hiring of what used to be net 20 a year, now net 30 going to net 40, we see that as a big growth driver for the business.
Okay, great. So Paul, I know your history, I guess, is as a salesperson. We've been buying the stock. You as a company have been buying the stock back as well. So maybe just end off with your pitch. Franklin Covey here, 43 and change. Why do you think it's a good stock though, and kind of, in this environment in general?
Yeah, I think a couple things to say there. One, what we do is incredibly important, and it's seen as important by the customers that we serve. We're on. It feels good to work at a place that's focused on real issues, endurable issues, intractable problems, things that aren't just going to get solved tomorrow. And so, that's I think it's from that standpoint, it's both a great place to work and I think a great company to be affiliated with. We have a wonderful brand and we're recognized as a leader in the space that we operate in. We have massive headroom and we are just scratching the surface. And what I'm excited about personally is having, kind of taking the reins this last year, is that the foundation that's been set is it's a really strong foundation. A lot of, we're competing in this ed tech space where there's a lot of scrambling going on right now. A lot of the companies aren't profitable. They've been getting by, on investor money. The investors are subsidizing to a great degree the cost of customer acquisition, right? That's all kind of coming apart now. That's not been us. We've been, we used to say we were a unique kind of company, and it sounds strange to say that because it shouldn't be unique to both generate increasingly high top line growth and also increasingly high levels of EBITDA and profit. That shouldn't be a unique thing, but it has been the last number of years. We are that company. We generate increasingly more and more top line growth, as I mentioned, having moved from the high single digits into the low teens now, and we think moving into the mid teens in the years to come. And doing that without sacrificing good growth in EBITDA. EBITDA margins continue to expand. EBITDA growth continues to expand. And we expect that will continue to be the case. We generate a lot of cash, and we intend to redeploy that cash first into things that would help the business grow organically. We think there's a lot of growth and a great growth story organically. Second, into things that we could bolt onto this that would help turbocharge that organic growth, whether it's additional sources of revenue or its capability that we'll need to help us on the climb in the future. And then third, we have shown a great willingness to return excess capital to shareholders. We've retired a lot of shares over the last many years, and we did in our third quarter retire a number of shares again. And so we'll use our cash, which we expect to generate a lot of. We are and expect to in the coming years across those three use cases. Last thing I would mention is we're happy and pleased with the subscription business model. I mentioned a little bit about the nature of multi-year contracts, but we retain, we report that we retain more than 90% of the revenue from year to year, but it's it is more than 90, quite a bit more than 90. For every dollar of subscription revenue we generate about 50 cents in additional services. So those services are very sticky for us. So we enjoy high client retention, high revenue retention. The model, and I think that's represented. It's a representation of the impact we're having on our clients. Our mantra is we want clients for life. Once you're a client, we don't want to let you go, and we have a great client engagement support model to drive that. So I think it's been a good run. Things are going well. We really believe we have a solid foundation upon which we can continue to make investments and grow even more rapidly in the future.
Terrific. Well, Paul, thanks so much for the time today. Griff, I think there might be some questions out there that people have for Paul. So if there are any.
Yeah, absolutely, guys. A couple questions first on the client partners at FC, Paul. Could you walk us through some of the incentives that you guys are dangling to retain some of your client partners, and specifically what your expectations are for growth in that space and what your confidence is in terms of hitting those targets?
Great. So our comp plan, first of all, we pay around 12% of sales in the form of commissions and accelerators on commissions. So that salesperson earns about 12% of what they sell. We do some things to incentivize them to, they make a little more if they bring in a new logo, if they sign a multi-year contract, we get a little bit of it. So we have we incentivize them to drive the overall metrics that we want, but it's roughly 12% all in. In terms of retaining that talent, one of the things that we have enjoyed across the entire company and within our sales force is really high retention rates. The culture at Franklin Covey is quite good. It's the company. The culture really does reflect the kind of company it better reflect if we're out there helping organizations improve their leadership, make sure people have the habits that they need to really work well together, working with companies on their culture, and being a good company that executes, right? We do eat our own dog food that way. And so the culture, I think, because it is a good culture, we retain great numbers of people. We did not lose, compared to what happened in the broader industry during the great resignation or whatever you want to call that. Our retention wasn't as good as it had been but we're talking like it was a couple of points worse. We have had a fundamentally different experience that way. We set the goal this last year to hire 30 net new client partners, which was up from kind of the run rate we'd been at, which was to hire net 20 a year. And we hit that goal. And as I mentioned, we're going to go hire net 40 this upcoming year that we're now in. Our fiscal year started September 1. And we're finding actually the recruiting, it was difficult there for a while, finding great salespeople. It's actually gotten a little bit easier of late because many of these employees or these salespeople that were being offered kind of crazy amounts to go work somewhere. And those companies are in a different spot today. And I think there is a flight to security and safety whenever things get a little bit more challenging. And I think we are that security and safety. We've got a couple of people who did leave us who came back and said, hey, actually, that adage of the grass is greener, could I come back? And so if they're good, we'd love to have them back. So we have a great team that recruits. We're tapped into what we need. We kind of know the profile where we go to get that profile. And so we're confident that we'll be able to continue to hit the hiring rate. I think in the future, we'll be able to bump that up you'll see us move from net 40 to net 50, net 60. We'll have hundreds and hundreds of salespeople here in the coming years, because our mission and what we're trying to do will require it. So I don't know if that's completely responsive, but that's where we are on the client partner hiring front.
Great. You mentioned how the business has fared during downturns. I was wondering if you could kind of expand on that. During the GFC, for example, the organizational solutions revenue came off around 15%. Do you think it's fair to assume in the event of a severe downturn, in the next 12 months or so, that we expect a similar impact on revenues, or do you think the change in the business model should cushion this impact somewhat?
Yeah, I think I think it'll cushion it and cushion it substantially. Two reasons for that. One is the business model. So much of the revenue now is in place with existing customers, where we're built into their multi-year plans. They've already got the subscription. We saw this in the early days of COVID. I mean, I was certain companies like United Airlines and Marriott and others would be like, yeah, we got to stop, right? I mean, nobody was flying, and they didn't. They doubled down with us, because they recognize, hey, this is a chance, we can use this. We've already got these plans underway, and not only did they stay with us, they expanded, they renewed, and so I think the problems were on the business model, the fact that we're embedded with these clients. So that's a different thing than it was back in the great financial crisis, when it was a bit more of an episodic relationship. The second thing I think that's different, and I don't know if this will be the case, but that was a real shock to the system, right? We all wondered, like, who's going to be in business tomorrow with that one. I don't know if you all thought that, but you woke up and you weren't sure what the headlines were going to be the next day. I suspect this downturn will probably be a little bit more maybe prolonged, but it's not going to be the companies going out of business every day and you're reading about them in the paper. It's going to be companies tightening their belts. It's what's driving this one. It feels a little bit different than COVID or the great financial crisis, the underpinnings of what's causing this. And so I think, inflation will be high for a while, and the recessionary headwinds will be there for a while, but companies will think more carefully about what they spend. But I don't think companies are going to be out canceling contracts. Certainly those that not those that we're working with today. So I think it will be I hope and I expect it'll be quite different than even the great financial crisis was for us.
Can you talk a little bit about CAC here? How's that been trending the last couple of quarters? And, do you see it improving sequentially over time, considering, a less intense sort of competitive landscape here?
Yeah. Our CAC hasn't really changed. We've been fairly disciplined on that. And I think what will play into our favor is that we've been competing, as you mentioned, as you alluded to, in a landscape where people have been spending in crazy amounts of money to acquire a customer. And we've just stayed more disciplined there. And I think a lot of these competitors have gotten by with probably weaker sales execution and marketing execution because they've been willing to spend their way to a new customer. And that's just not been the way we've operated. We've always wanted to have a healthy bottom line along with the growing top line. And so we have great sales execution, great marketing execution. And I think actually that pendulum swinging back our way a bit.
Okay. Last question for me. Going back to the capital allocation side of things, specifically honing in on, potential M&A. Do you think valuations have come down enough in the private market for you guys to get a little bit more aggressive on sort of accretive M&A transactions?
I do. In fact, I should have introduced him earlier, but the other Paul Walker on the screen you see is actually Boyd Roberts. He stole my name today, but Boyd leads corporate development for us and also investor relations. And so the space we're in is really crowded. Lots of companies got in this space, some of them tech enabled, some of them are old historical players that haven't been able to make the transition to subscription or make the technology investments they need to. And so there's just a tremendous amount of noise in the space. There's going to be a sorting out that happens. And we think we could be part of the sorter outers of that. We think about acquisitions in three categories. Acquisitions that could be content related. Now, oftentimes we can license content. We don't need to go buy a company for their content. We can license it. But you could acquire something for its content. You could acquire something for its capability. That was certainly what we did with Strive. We bought capability that we needed. We did an acquisition a few years before that of a company called Jhana, which was also Silicon Valley based, and they were a micro push content company. And so that was the capability as well. We bought a coaching company a few years ago called Robert Gregory Partners. We wanted to add the coaching capability. So that second area of potential acquisition would be around capability. And then the third would be, can we buy something where we add customers, we add revenue to bolt on top of the growth we already think we can achieve organically. And so as we look at the landscape, we see pretty target rich environment out there. And given the cash we're throwing off, we think that that's an area where we ought to be and can be a little bit more aggressive. We're not going to go, because we have a really strong organic growth story, you're not going to go see us do something that would be like transformative. I can't imagine that we're going to do something that would just lever the company up so far that it would just all of a sudden potentially be a weight on us. But I do think there's a chance to do something more than just the little tuck-ins we've done that could be a more rapid expander of revenue and capability.
Awesome.
Boyd's got his hands full. He's got a lot to sift through right now.
Undoubtedly. Well, Paul and Jeff, that was fantastic. Thank you so much for your time today. Really appreciate you guys coming on the program and sharing your insights. And hopefully this is something we can do with some more regularity going forward. We're looking forward to following the story.
Okay, really appreciate the invitation. Great to be with you all. Thanks, Jeff, too, for your questions.
Paul, thank you. Thanks, Griff.
Anytime, guys.
Okay. Have a great afternoon.
That was Paul Walker, CEO of Franklin Covey, and Jeff Meyers, CIO of Cobia Capital Management. If you have any questions or want to get in touch with either one of these two gentlemen, feel free to reach out to me in the interim, and we'll find a way to get you guys in touch. But I appreciate you all showing out today. Thank you so much for joining us, and we'll be back sometime soon.